Sunday evening, January 12, 2026. What I'm watching right now is something I haven't witnessed in over 12 years of tracking precious metals markets. While mainstream financial networks parade their usual green and red tickers, talking about tech stocks and market resilience, there's a deafening silence about what's actually unfolding in the metal sector. And if you don't understand what happened this weekend, you're about to get blindsided. Because physical silver just crossed $100 at major U.S. dealers while the spot price sits at $85. That's not a glitch. That's a crisis. And in the next few minutes, I'm going to show you exactly why this changes everything. I'm Robert, and I've been a private commodities analyst and physical silver investor for over a decade. I built what happened after using this format for one reason: speed. I'm done waiting for mainstream outlets to catch up to real-time market movements. And I'm especially done with channels pumping fake hype when retail investors desperately need accurate information. Here's what they're not telling you. While you were watching football this weekend, a criminal investigation was launched into Jerome Powell, chairman of the Federal Reserve, the man who controls the money printer. This isn't some procedural review or ethics slap on the wrist. The Department of Justice is investigating him over 2024 congressional testimony and office renovation expenditures that raised serious red flags. Mainstream media is framing this as minor volatility. They're insisting the Fed remains independent, in control, the steady hand on the wheel. But the physical silver market just told you something radically different. American Silver Eagles, the benchmark 1-ounce coin every serious investor watches, just crossed $100 at major dealers. Not spot price. Spot price is $85.55. I'm talking about what you actually pay to get physical metal in your hand. $100. That's not a temporary spike. That's the new floor. And it happened within 48 hours. For the first time in my career, the gatekeepers are being investigated by their own Department of Justice. The physical market just called their bluff. Stay with me, because what I'm about to reveal gets even more shocking, and it involves a rumor circulating on institutional trading desks right now about something called the LBMA short squeeze. Let me walk you through my primary claim, and I'll prove it with data, math, and real market mechanics. The DOJ's criminal probe into Powell has shattered the illusion of Federal Reserve independence. That loss of trust triggered massive safe haven flight into hard assets. That flight caused the physical silver market to completely decouple from the paper exchange. We're no longer trading a commodity. We're trading a crisis proxy. I pulled this data hours ago at 2 p.m. Eastern. Gold hit $4,610.54, a new all-time high. Silver spot closed at $85.55, up over 7% in a single session. That's massive for silver. But here's where it gets strange. While spot printed $85.55, I opened APMEX, then JM Bullion, then SD Bullion. Every major dealer in the United States had moved their brilliant uncirculated American Silver Eagles to $100 or higher. Some listed them at $102, $105. Smaller regional dealers went even higher because they were scrambling to restock from wholesalers who were already out. Stop. Look at that gap. Paper price says $85. Physical price says $100. That's a 17.5% premium. In normal markets, premiums on Silver Eagles run $3 to $5 over spot. Maybe $8 if supply is tight. 17% isn't normal. 17% is a divorce. The inventory situation gets even crazier. I have a contact at a mid-sized dealer in Texas who told me this morning his weekend order volume was 4 times normal Saturday traffic. But why is physical moving so much faster than the screen? The answer involves a mechanism most investors don't understand. And if you miss this, you'll get destroyed by headlines over the next few weeks. Let me break it down. The key mechanism is physical versus paper decoupling. I call it the premium gap. This is the divorce between futures contracts traded on COMEX and the physical metal you can hold in your hand. Two different markets. They're supposed to track each other, but right now they're not even in the same zip code. Simple definition. The spot price you see on every financial website derives from the COMEX futures market. That's paper. It's a contract saying you have the right to take delivery of silver at a certain price on a certain date. Most contracts never result in actual delivery. They're just bets on price direction. Traders close them before expiration. It's a casino where the chips are paper. Physical silver is what you buy from a dealer, hold in a safe, can't create with a keystroke. There's a finite amount. It must be mined, refined, minted, shipped, stored. It has mass. It has scarcity. When everyone wants it simultaneously, price must rise until enough people say no thanks. Think of it like this. Imagine concert tickets officially priced at $85 on the venue's website. But when you try to buy, it says sold out. If you really want in, you have two options. Wait and hope they release more at $85, or go outside where scalpers sell for $100. The $100 is the real price. The $85 is just a ghost, a number that no longer reflects reality. That's where we are with silver. COMEX tells you $85. But try buying physical at $85 and you'll get laughed out of the dealer's shop. The real price, what you actually pay to acquire metal, is $100. Here's the trap. If you only watch the ghost price on news, you'll never understand why local coin shops have no silver left. But there's something even more alarming. A rumor leaking from institutional desks right now about a major London Bullion Market Association vault facing delivery default. And if this rumor is even partially true, we're not talking about $100. We're talking $150 in hand while your screen shows $100. Let me explain. The gap is widening because of what's circulating on institutional desks. I heard it from two separate sources at firms you've heard of. The rumor, a major LBMA vault is facing delivery default. A big player, possibly a sovereign wealth fund or central bank, put in a massive order for physical silver, and the vault can't deliver. They don't have it. They sold paper claims on metal they didn't own, and someone called their bluff. I can't verify this rumor. I don't have inside LBMA sources. But I can tell you the premium explosion we're seeing is consistent with a delivery squeeze. When institutions realize they can't get metal at paper prices, they start bidding in the physical market. That's when retail investors like you get priced out. Let me run the math. Two scenarios. Conservative scenario, premium gap stabilizes at 17.5%, where we are now. If spot silver climbs to $100, simple math says physical eagles would price at $117. You're paying $117 for a coin the screen says is worth $100. That's the cost of scarcity. Stress test scenario. If the LBMA short squeeze rumor is true and institutional delivery failures escalate, we could see 50% premiums. I know that sounds insane, but it's happened in other commodities during crises. 50% premium on $100 spot puts physical silver at $150 in hand. You'd pay $150 for a coin while your TV says $100. Why I think the stress test isn't crazy. Technical indicators are screaming warning signs that don't match physical demand. The relative strength index for silver is at 77.9, deeply overbought territory. Historically, RSI above 70 signals pullback. Traders see that and think time to sell. But physical demand doesn't care about technical indicators right now. RSI screams overbought, yet dealers can't keep inventory on shelves. This isn't normal technical rally. This is fear-driven accumulation. People aren't buying because they think silver hits $90. They're buying because they think the financial system is breaking. Here's another data point that makes no sense in normal environments. The US dollar index, the DXY, shows resilience. It's not collapsing. Usually when the dollar is strong, precious metals get crushed. That's the inverse relationship from Economics 101. Strong dollar equals weak gold and silver. Weak dollar equals strong gold and silver. But right now, both are rising. Dollar is holding, gold just hit all-time high, silver up 7% in a day. That shouldn't happen unless this isn't a currency trade. Unless this is a liquidity black hole event. Money is fleeing into anything that feels safe. Dollars, gold, silver. Doesn't matter. People want out-of-risk assets. The numbers don't match history books because history didn't account for a Federal Reserve chairman under criminal investigation. That's the variable nobody priced in. The Fed's independence was always myth, but a useful myth. It kept the system stable because people believed the Fed was above politics, corruption, reproach. That belief is gone. Once trust evaporates, price discovery gets violent. Let me address the skeptics head-on, because I've seen the counter-arguments. They're saying this is a politics-induced blow-off top, RSI is overextended. Once DOJ headlines fade, silver crashes back to $70. Just retail hype from fear-mongering content creators. Here's my rebuttal, and it involves what Morgan Stanley just told their institutional clients. I'd agree if this were just retail-driven. Retail can't move markets this size. Retail doesn't have the capital. But this isn't just retail. I saw a Morgan Stanley research note from Friday. Their entire commodities theme flipped to stay with metals. They're now telling institutional clients to buy silver as fiscal risk hedge. When big banks start recommending what they usually tell clients to avoid, the floor moves up. Morgan Stanley isn't a silver permabull. They don't care about silver. They care about making money for clients. If they're rotating into metals, their risk models are flashing red. Let me myth-bust another idea, that higher rates always mean lower gold and silver. That's the CNBC narrative. Fed raises rates, gold and silver fall because they don't pay yield. Cash and bonds become attractive. Simple story. Also wrong. Go back to 1979 and 1980. The Volcker Fed raised rates to 20%. 20. And silver went to its all-time high of $50 during that exact period. Why? Because the market didn't trust the federal rate hikes were proof inflation was out of control, not that the Fed controlled it. The market front-ran the chaos. We could be in similar setup. If the Fed hikes rates this year trying to restore credibility, it might have opposite effect. It might signal panic. If the DOJ probe continues, every rate hike looks like desperate attempt to save face. Here's what I'm watching. The institutional reaction, specifically COMEX. When paper markets lose control of price discovery, exchanges do what they always do, hike margin requirements. That forces retail traders long silver futures to either post more cash or close positions. It's shaking out weak hands. And it works. Every time they hike margins, you see temporary price dips as traders liquidate. I expect COMEX to announce margin hike within the next week, maybe two. If they do, spot price will probably pull back to $80 or $75. Financial media will say, see, rally's over, silver is crashing. But if you understand the mechanism, you know paper price dipping doesn't mean physical follows. Dealers might drop premiums slightly, but the $100 floor is likely sticky now. I'm also watching the gold-to-silver ratio, the GSR. This is how many ounces of silver it takes to buy 1 ounce of gold. Right now, with gold at $4,600 and silver at $85, the ratio is about 54 to 1. Historically, long-term average is around 60 to 1. When the ratio drops below 50, it signals silver outperforming gold. It means silver mania is starting. If we see GSR break 50, I'm expecting face-melting rally in silver. The kind that gets normal people asking financial advisors about buying coins. That's when it gets dangerous, not because silver crashes, but because premiums go parabolic. You could see 40 or 50% premiums when retail panic buying hits. The media response will be predictable. Expect coordinated silence at first. Major networks won't cover silver because it's inconvenient. It raises questions about Fed credibility, central bank manipulation, financial system stability. Topics they avoid. When they do cover it, they'll call silver a meme metal, compare it to GameStop and AMC. And that's exactly when you should pay closest attention. But there's a wild card scenario I need to tell you about that could change everything. I call it hike to spite. There's an unverified rumor that the Fed might hike rates aggressively this year, not to fight inflation, but to crash the economy and undermine the DOJ investigation. The logic: if Powell faces criminal charges, his best defense is showing that removing him or weakening the Fed would be catastrophic for markets. So he engineers a controlled crash, blames political interference, uses chaos to rally support. I don't know if this is true. Sounds like conspiracy theory, but the Fed has done stranger things. If it is true, we're entering extreme volatility. Rate hikes would crush equities and real estate, but might send gold and silver even higher as people flee into hard assets. So what am I actually doing with my own money? Let me give you my personal battle plan. This isn't advice. This is what I'm doing. You do your own research. Trigger 1. The $80.50 support test. If spot silver retraces to $80.50 and holds, I'm viewing that as structural confirmation to stay aggressive. Rally has legs. Dip buyers are in control. If it breaks below $80 and keeps falling, I'm lightening up. Not catching falling knives. Trigger 2. The 25% premium cap. If physical premiums hit $106 while spot stays at $85, I'm sitting on my hands. I refuse to pay 25% panic tax to dealers. At that point, risk-reward is broken. I'd rather wait for premium compression or spot price catching up. Trigger 3. GSR at 50. If gold-to-silver ratio hits 50, I'll look to rotate a portion of silver gains back into gold. Not because I'm bearish on silver, but because I want to lock in profits and rebalance. Silver is more volatile than gold. When it runs hard. But when it crashes harder. I don't want to hold the bag at the top. My personal stance: I'm not buying the ghost price. I'm not making decisions based on what screens tell me. I'm watching local shop availability. If supply vanishes completely, price becomes irrelevant. You either have it or you don't. And if you don't have it when the system breaks, good luck getting it at any price. Let me take you deeper into historical context, because if you don't understand how the Fed has intervened in metals markets before, you won't recognize the playbook they're about to use. Go back to 1980. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, tried to corner the silver market. They bought physical silver and futures contracts. At one point, they controlled almost half the world's deliverable silver supply. Price went from $6 in 1979 to $50 in January 1980. The establishment panicked. COMEX and Chicago Board of Trade changed rules mid-game. They banned new long positions in silver futures, hiked margin requirements, implemented delivery limits. All designed to force the Hunts to liquidate. It worked. Silver crashed from $50 to below $11 in weeks. The Hunts went bankrupt. Here's why that matters now. The Fed and exchanges have a playbook. When silver's price threatens the system, they change rules. They don't let markets run free. They intervene, always justifying it as protecting market stability, preventing manipulation. If we see Hunt brothers repeat, here's what it looks like. First, margin hikes on COMEX. Already in the cards. Second, delivery restrictions. Exchanges might say you can only take delivery of certain amounts per month. Third, coordinated media attacks. Financial press will say silver is a bubble, irrational, manipulated by retail speculators. Gold is scaring you into selling. It works on most people. They see 20% price drop in 3 days and think, I need out before it goes to zero. But if you understand the playbook, you know the dip is artificial. Not driven by fundamentals. Driven by rule changes designed to break rallies. Now here's what's different this time, and why 2026 isn't 1980. In 1980, the Hunt brothers were speculators trying to corner for profit. The Fed could paint them as villains. But in 2026, buying isn't from two billionaires. It's from sovereign wealth funds, central banks, pension funds, retail investors terrified of what DOJ investigation means for dollar stability. You can't paint that as manipulation. And there's a geopolitical angle that makes this even more explosive. I'm seeing reports that China and Russia have been accumulating gold and silver reserves for years. If they smell blood in the water, if they think U.S. financial system is weakening, they might accelerate accumulation. That would put even more pressure on physical supply and turn the silver market into proxy battleground for much larger economic war. The U.S. isn't the only country dealing with central bank confidence crisis. European Central Bank has been under fire for years. Bank of Japan is trapped in zero-rate policy, can't see escape without crashing their bond market. China's economy is slowing. The entire global monetary system is under stress. When central banks lose credibility simultaneously, flight to hard assets becomes stampede. It's not just Americans buying silver. Europeans, Asians, Middle Easterners. Everyone with dealer access is trying to get physical metal. And supply is finite. Only so much silver mined each year. Only so much inventory available for delivery. That's why I think physical paper decoupling isn't temporary glitch. It's the new normal. As long as trust in central banks is broken, the premium gap will persist. You will pay more to hold physical than trade paper. That premium is the price of certainty in uncertain world. Let me give you another layer of COMEX intervention playbook. It's not just margin hikes. Exchanges can implement position limits. That means they cap how many contracts any single entity can hold. Stated reason: prevent manipulation. Real reason: prevent large players from forcing delivery. If you own 10,000 silver futures contracts at 5,000 ounces each, you have right to demand delivery of 50 million ounces. That's massive silver. If COMEX doesn't have it in vaults, they're in trouble. So they cap your position at, say, 1,000 contracts. Now you can only demand 5 million ounces. Still a lot, but more manageable. Watch for position limit announcements. If COMEX suddenly announces new limits on silver futures, it signals they're worried about delivery squeeze. That's actually bullish for physical silver price. It means the exchange is admitting indirectly that paper market is fragile. Let's talk supply side. Silver is unique because it's both monetary metal and industrial metal. About half of silver demand comes from industry: electronics, solar panels, medical devices, water purification. Other half comes from investment and jewelry. If we're in economic slowdown, industrial demand should drop. That's bearish. But if we're also in monetary crisis, investment demand should surge. That's bullish. Question is, which force wins? Right now, investment demand is overwhelming any slowdown in industrial demand. But that could change. One thing to watch: solar industry. Solar panels use silver paste in photovoltaic cells. If there's solar boom, that could tighten physical supply further. On the other hand, if solar subsidies get cut or industry slows, that frees up silver for investment demand. Mining side is also critical. Silver is mostly mined as byproduct of other metals: copper, lead, zinc, gold. Only about 30% comes from primary silver mines. That means silver supply isn't very responsive to price. If silver price doubles, you can't just open new mines overnight. Takes years to develop a mine. That inelasticity of supply is bullish in demand surge. Market can't quickly adjust to bring more silver online. So price has to do all the work. It has to rise until enough marginal buyers say, "That's too expensive, I'm out." Given the monetary crisis dynamic, I'm not sure where that clearing price is. Could be $150, could be $200, could be higher. Here's a historical comparison that should terrify you. Weimar Germany, 1923, hyperinflation. Currency collapsed. People burned money for heat because it was cheaper than buying firewood. In that environment, physical goods became only store of value. Silver, gold, real estate, tangible assets. The U.S. isn't Weimar yet. But the loss of confidence in the Fed is the first step on that path. And the demographic driving this rally might surprise you. The demographic driving this rally: it's not ultra-rich. They're buying gold, art, real estate. It's the middle class. People with $50,000 or $100,000 in savings, terrified of it getting inflated away. They can't afford 10 ounces of gold at $4,600 each, but they can buy 100 ounces of silver at $100 each. It's accessible. It's tangible. It's insurance. Let me tell you what happens if the Fed tries to pivot and cut rates. Say DOJ investigation fizzles out. Powell survives. Fed decides to cut rates to juice the economy. In normal world, that's bearish for dollar, bullish for silver. But we're not in normal world. If Fed cuts rates after this crisis, it'll be seen as surrender. Signal that they have no credibility, no independence, no control. Market will interpret that as weakness, and flight to hard assets will intensify. Even dovish pivot could send silver higher. That's the trap the Fed is in. They're damned if they hike, damned if they cut, damned if they hold. Only way they restore credibility is if DOJ investigation concludes with Powell fully exonerated and media narrative shifts to "Fed saved us again." I don't see how that happens. The damage is done. The cat is out of the bag. People are questioning institutional legitimacy. Once you open that door, you can't close it. Here's my forecast for the next 3 months. I think we'll see massive volatility. Sharp moves up, sharp moves down. COMEX will hike margins. Media will call it bubble. Retail will panic sell. Institutions will buy the dip. Then price rips higher again. By March, I expect spot silver to test $100. By April, I expect physical premium to compress slightly as dealers catch up with inventory. But $100 floor should hold. By May, if DOJ investigation is still ongoing, I expect another leg up. Could be $120, $130 spot. Physical could be $150 plus. The risk is black swan event nobody's pricing in. Or debt crisis. Currency collapse outside U.S. triggering contagion. If that happens, all bets are off. Silver could go to $200. It could also get locked down by government emergency orders, capital controls, export bans. There's precedent. In 1933, U.S. government banned private ownership of gold. They could do same with silver if threatened enough. I don't think that's likely, but I'm aware of the risk. That's why I don't have all net worth in silver. Diversification still matters. I have some gold, some cash, some real estate. Silver is my crisis hedge, not entire portfolio. Let me talk about psychological warfare you're about to experience. Financial media will try to break your conviction. They'll bring on analysts saying silver is overvalued. They'll show charts with bearish technical patterns. They'll interview people who bought at 1980 top and lost everything. Message will be clear: don't be that guy. Sell now before you lose it all. You need to decide right now whether you're trading or holding. If you're trading, set stop losses and take profits along the way. If you're holding long-term as insurance against monetary collapse, ignore the noise. You can't do both. Can't say you're holding for apocalypse then panic sell when price drops 10%. I'm in the holding camp. Not trying to time the market. Trying to survive systemic breakdown. That means I'm okay with paper losses. Okay with price going down temporarily because I'm not measuring success in dollars. I'm measuring it in ounces. If I have 100 ounces today and still have 100 ounces next year, I won. Dollar price is irrelevant if dollar is collapsing. That's very different mindset from trader. Trader is trying to grow capital in dollar terms. Buy low, sell high, rinse and repeat. I respect that approach, but it's not what I'm doing. I'm insuring against world where dollars don't matter anymore, or where they matter so little that holding them is guaranteed loss. Let me give you practical tips for buying physical silver. First, know your dealer. Not all dealers are created equal. Some have been around for decades with solid reputations. Others are fly-by-night operations that disappear when markets get volatile. Stick with established players: APMEX, JM Bullion, SD Bullion, Provident. These are names you can trust. Second, compare premiums. Don't just buy from first dealer you find. Check multiple sites. Sometimes the difference is $5 or $10 per coin. Over 100 coins, that's $1,000. It adds up. Third, understand the products. American Silver Eagles are most recognizable and liquid, but carry highest premiums. Canadian Maples are almost as good, usually cheaper. Generic rounds are cheapest but harder to sell. Bars are in between. Know what you're buying and why. Fourth, secure your stack. Don't tell people you have silver. Don't post pictures on social media. Don't brag. You're making yourself a target. Buy a safe, use private vault service, or bury it. Just don't leave it in a drawer where any burglar can grab it. Fifth, plan your exit. At some point, you'll want to sell. Maybe you need cash for emergency. Maybe you hit profit target. Maybe mania phase is over and you want to rotate into something else. Know where you'll sell. Local coin shops usually give best price. Online dealers buy back but take bigger cut. Private sales can work, but there's risk. Let me recap where we are. The Department of Justice opened Pandora's box by investigating Jerome Powell. That shattered the illusion of Fed independence. Physical and paper silver markets decoupled. $100 is the new real floor for American silver eagles, even though spot price is $85. We've explained the premium gap mechanism. We've run the math on conservative and stress test scenarios. We've addressed skeptic arguments. We've explored historical context, geopolitical dimensions, and intervention playbooks. The financial system as we knew it is changing. The old rules don't apply. The old correlations are breaking. This is not just about silver. This is about trust, credibility, and what happens when the institutions we relied on lose legitimacy. If you found this analysis valuable, subscribe to What Happened After for real-time market intelligence that cuts through mainstream narrative. Hit that notification bell because what happens in the next few weeks could redefine precious metals markets for a generation. I'm Robert, and I'll see you in the next one. Stay sharp, stay informed, and remember, in times of crisis, physical assets speak louder than paper promises.